So in this presentation, I'm going to be focusing on understanding costing and pricing in hospitality. So in this presentation, I'm going to teach you about the importance of financial statements, which different financial statements different stakeholders use, why control is important in a business, and why reports must be produced in a timely manner. So an example of a financial statement would be a profit and loss account. So a profit and loss account is a statement of revenues and expenditure, and they're used because it's an easy way to record profits and losses. So it shows a net profit or loss in a specific period of time. There are some advantages of using a profit and loss account. One of them being that it breaks down all costs. So each cost will be split up to food or furniture, for example. Another advantage would be that it tracks the performance of the business, so it shows how much is being made and shows how well the business is doing. And also it's the basis for forecasting, so it shows the future profits and losses, or really any other figures. Some disadvantages of that is not a complete picture, so it can be the only thing looked at by the owner of a business, and it can have a bad effect on the business, as it doesn't give a it's not a complete complete it doesn't completely determine the performance of the business. And also it can be reported too often, so it gives that basically gives it an unrealistic figure, as there isn't enough data to make a proper assumption. Another financial statement would be a balance sheet. So a balance sheet is something that gives a company an idea of what position they're in, and it's used to give an overall financial health check. So a balance sheet is made up of three things. So it's made up of a company's assets, any liabilities, and shareholders' equity, if applicable. These three financial areas give investors an idea to what the company owes and owns, as well as the amount invested by shareholders. Again, there are some advantages of a balance sheet. They include, so they allow investors to return prospects. So this basically means that investors can tell the company what profits they're going to make in a specific period of time. Also, it reduces the bankruptcy risk. And that's because it shows what the company owns and owes. And that makes it easier to see when they need to stop spending, or when they even need to stop saving, when they need to start saving money. And also it shows the use of assets. So it shows which assets are being used and if they are being used with effect. Again, there are some disadvantages of using a balance sheet. These include that that figures can be misleading. So if the company's cash status is high, at a certain point, managers then find it easy to invest some of the money, which could distort the data in the balance sheet. And also, not comparing the figures it could be a big issue, because if you do compare them with bigger and better companies, you can then see if your figures are the best they can be. And also, if the assets are not correctly priced, then because each asset must be recorded by their current value and not what price it was bought for. And as the price of the asset may not be a real insight into what it's currently being sold for, or what it's currently worth. Cash flow. So cash flow is another financial statement. Cash flow is the continuous movement of cash into and out of the business. It's basically when money is used to buy resources, which is then used to make goods and services, and then these goods and services are then sold for cash. So it's used to see when cash is running low. So this is important. It's important as the earlier it's spotted, the longer you have to find a solution for it. An advantage of cash flow would be that it can help predict future profits. It shows the cash position of the company, so how much what they have at that time, and also it increases better decisions. So it gives you the knowledge you need to make better informed decisions. There are some disadvantages of using a cash flow. One being that it uses past information, and another being that it is not suitable for measuring profits. Another financial statement would be a budget. So a budget is a planned amount of money a company has to spend in a certain time period. And also it's used to set out the cost and revenues expected. So it's basically make sure that a company doesn't overspend, and also tells them what products they can buy and what quality products they can buy also. There are some advantages of using a budget. These can be that you can plan ahead. So by spreading money across the year, expenditure can be planned so that budget lasts and the business doesn't run out of money. You can budget all of the different areas, so it allows you to have a budget for each individual thing. For example, wages, food, and furniture. And also, it allows you to prepare for any unexpected expenditure, so any unexpected cost which you didn't see coming. So basically allows for managers to leave money on the side for unexpected payments which need to be paid. There are some disadvantages of using a budget. They can be that it costs to plan a budget, especially for big companies. So as big companies will employ accountants to budget for them, which is costing them money at the same time. If there are any errors can appear in a budget. So any errors which include energy prices increasing, a recession, interest rates rising, or anything really which is unexpected. And also a conflict between departments can be a huge issue, as if other departments have lower or higher budgets than others, then an upset between them may be caused. So another financial statement would be a budget, a forecast. So a forecast is a financial prediction of expenditure. So basically to predict your budget, and it's used to determine budgets for the coming year. Some advantages of using a forecast would be that it's used to see future outcomes. So it helps you to see the best possible outcomes for a good mindset. And also it provides valued information. So the information generated can provide the company with an idea of where the future lies and what lies ahead. And also it predicts customer demand. So it helps you to see what customers are buying and what is in high demand. And then some disadvantages include it's basically impossible to predict the future. So if too many things can change. So if living wage is introduced, which then increases the wage bill, oil prices, for example, increasing, because basically they can change overnight. So and gas and electricity prices can increase also. Poor reviews might change the future outcomes. People stop going out to eat. Interest rates going up. Mortgages getting higher. Income drops. And even if a new restaurant opens up next door, you just never know you just can't predict that in the future. And also making a decision on a bad forecast. This it can cause problems to a company's financial situations. So, of the financial statements on the previous slides, some of them will be used by the stakeholders, which you're about to see on the next few slides. So, a general manager would only really use a profit and loss account, a balance sheet, a budget, and a forecast. And that's basically to ensure that they're hitting their targets. An operations manager would use all of them, as they are dealing with the business overview as a whole. A CEO would use all of them again, as they are used as they use them to see to have an insight into the whole financial dealings with the business. Shareholders would only use profit and loss account. This is because the shareholders are only really interested in how much the business is making or losing. A chef would only need a budget, as they have the responsibility for ordering everything for the kitchen. And a supervisor would only really use forecasting, as they may only need to know targets for coming months. So control in the business is crucial, as strong financial controls are really important in the business, as they ensure that management understand the strength and welfare of the business. This will help to grow the business and give targets to meet, and ensures that money isn't wasted. It makes sure that you are sticking to your budgets, and also that you are not overspending. And it ensures that you have the money you need to spend, because otherwise it just won't work out. And also reports in a business are crucial as well, as having reports. It's crucial to have reports produced in a timely manner, because if a report is not up to date, then up-to-date figures will not be known, and any necessary changes cannot be made. If you look at a report which looks at figures from the past, then they won't give an up-to-date and accurate view of the financial health of the business. So, and a large business with a higher turnover may want more frequent reports, for example, a report every 2 months. A medium-sized business only really likely to request reports every 6 months, and a small business maybe even once a year. Thank you for listening to my presentation, and I hope you enjoyed.